You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back for the second time this month, doing double duty out here on the Advisor's Option. Yes, the program for you out there, the busy financial advisors and asset managers. We get it. You're busy doing your actual job right now. At least you should be. There's a lot to keep your plate full and keep you busy these days out there with the vol and the Fed and Ukraine and everything else going on out there. Luckily, we're here for you. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the fine network upon which so many of you are mainlining these days. Remember, if you're just listening to the Advisor's Option, you're missing out on a whole bunch of other stuff. If you like the educational component of the Advisor's Option, then clearly a lot of you do. But then, of course, you have Options Bootcamp, Options Playbook Radio that are hanging out there for you. And, of course, if you want to go above and beyond, we're just coming off. Speaking of double headers, we got a double header going today, just coming off, hot off the heels of a great pro Q&A session here for all of our pro members out there. Dove deep into all the madness going on in the world of crypto. If you want to participate in those Q&As, get options oddities, get the giveaways, everything else that we do, as well as, of course, engage with this show and every other show that we do live throughout the week. So if you have questions, you want to get at it, people right away, myself, the host, the guests, all the other stuff that we do, theoptionsinsider.com/pro is the place to go to learn more. And of course, however you listen, we do appreciate, if you like what you hear, that you keep rating and reviewing on the on-demand side, and you keep sending in those questions as well. We do love to hear from all of you folks out there. Let's see who we're hearing from on the old Advisor's Option program today. First off, we have summoned him back twice in the same calendar month, making him do double duty. None other than Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services, a.k.a. the Oracle of New Hampshire himself. Mr. Matt, welcome back to the program. We are certainly working you this month, sir.
Yeah, I'm used to it, Mark. And for trading, you just take a deep breath, go outside, look up in the sky. If you don't see any ICBMs, you buy.
Yes, that's all it takes. I think you're kind of safe up there in the hinterlands of New Hampshire. You're probably, I have to say, lower on the target threshold, but, maybe eventually they get to you up there as well. But also joining us, he's not quite in the hinterlands of New Hampshire, but he is in the hinterlands of Chicago, a sleepy hamlet known as St. Charles. You know him, you love him from the Option Block. He is none other than Mr. Uncle Mike TOSAW from St. Charles Wealth Management, a.k.a. one of the few advisors out there who are actually using these options things. Tailor-made for the audience of this program. He is the audience of this program. Mr. Uncle Mike, welcome back to the program to you as well, sir.
Always happy to be here to talk about advisors who are doing good things for their clients with the options.
All right, then let us commence the journey. Let us dive right on in. It is time for the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody, welcome to the P&L statement, the segment that was born of the pandemic as we kept spending so much time at the start of every show, really just breaking down what the heck happened since the last time we all gathered here together. So many unprecedented things were happening week in and week in, month after month here on the show. So we thought it deserved its own segment. And of course, we are coming at you now, like I said, for the second time this month. So an interesting perspective we have now looking back, because on our last episode, it was early on in the month, and of course, we were still just knee-deep in a lot of the morass that was Ukraine. We were all still waiting for the Fed as well, didn't know what was going to happen there. Fast forward towards the end of the month, we have heard from the Fed, and we are still knee-deep, unfortunately, in the morass of Ukraine, even though maybe there's a bit of a silver lining, maybe perhaps some peace talks are undergoing right now, maybe some talks of Russia pulling back to some of its earlier borders there. So perhaps there is some optimism out there. All that is leading to a whole heck of a lot of green on the screen yet again today, listeners, and has been pretty much for multiple sessions now in a row. We also have seen broad volatility continue to dwindle. In fact, we are back below the 20 handle, listeners. It's been a while since we could say that with any sort of really reliable accuracy. We've been hanging out certainly since all this Ukrainian madness started percolating on the horizon. We have been hanging out north of 20. How many weeks in a row do we have our special guest star, Mr. Kenny Loggins, joining us on the Volatility Views program? Because we were north of that 25 level, listeners. Well, now back as we're kicking off the show here at right about a 19 even. So a full point below that 20 handle. So a lot to unpack. We shall go out to our guests first, Mr. Uncle Mike, sir. A lot going on in the broad markets right now. What are your thoughts on overall volatility, on overall market valuations, and just what we're seeing out there for the advisors and asset managers out there right now, sir?
Well, I mean, today we're knocking on the door of being positive for the year again. Going into today, 4,600 on the SPX was a number that I was looking at because we never really got through it a little over a month ago when we made a test of it. So we ran through that door relatively easily today, and we could not break the 4,600 mark. I'm just looking back at a chart here on February 2nd, as well as February 9th and February 10th, when we were kind of up in that area for a little bit. But it's roughly a month and a half later, and we went through it fairly easily. So as far as I'm concerned now, from a technical standpoint, I mean, I'm not much of a technician, but just in looking at this, I think the next key barrier is the open of the year, I should say the close of 2021. And that number is 4766. I could see us breaking through. I mean, you could argue because 4,700 could be a kind of a key number that maybe that could be another barrier, but I think it's close enough to where the open of the close of 2021 was that's the next level of anything in serious resistance mode. But we're kind of in no man's land right now in that we're not buying a dip and we're not making new all-time highs. So I think that's something that needs to be taken very cautiously. Some other things with which I'm seeing right now in the marketplace, VIX is below 20 again. And it seems like it's been a million years since that's happened. But we are below 20 again on the VIX. So that can be good or bad, just depending on what strategies that you have going on. And then a couple other things that I'm watching that I think are really a factor, maybe not directly with client portfolios, but definitely indirectly with areas with which you need to continue to keep an eye on. Oil's still above 100. And so even though we're having these rallies lately, and it feels like the good old days when the market goes up 1% every day all the time, bears, who cares about the bears? What could possibly go wrong? It does kind of feel like that again in the marketplace, but understand we still have crude oil prices above 100. So I really believe that caution needs to be taken when looking at these markets. We had a little bit of a rally today in the 10-year note. So I'll be curious to see where that can continue to go. So definitely watching that. We have non-farm coming up on Friday. We got events going on, or event risk that we have going on with the Russia-Ukraine conflict. It's not over yet. Even though Russia says that they've made progress, it's still not over. So for those of you in the audience that listen to the option block, I am the most bullish person on this network, I'm convinced. But I still think that we have a lot of things with which we need to be cautious about when looking at this market. So that's what I'm seeing right now. And I will turn it back over to the sexiest man in options, Mark Longo.
Well, at least someone knows the truth out there, Mr. Uncle Mike. Well said. Well said. But you're right. This is an interesting period. I can't recall off the top of my head another period like this where we're seeing the markets rally so aggressively in the face of the Fed coming out and saying, we're going to start raising rates, then coming out a week later and saying, actually, we're going to be even more aggressive than we said last week on raising rates. Usually a bit of a bearish sign for the markets, yet the markets kind of just took that and went full steam ahead with it. Also, as you mentioned, we have serious event risk still going on. And of course, we have crude lurking well north of $100 a barrel. So all three of these factors at play. And yet, if you were just looking at the broad markets without any other context, you would think all was right with every aspect of the market in the world, which these are interesting times. Like I've said, that's the old Chinese curse / proverb. May you live in interesting times. We are all certainly living through them together right now. It's going out now to the hinterlands of New Hampshire. I think he's back. He just ducked out for a second to go check on the status of the ICBMs. Mr. Matt, sir, now that your skies are clear, what do you have in store for us today, sir?
Well, Mike certainly got my attention with the sexiest man in options.
What can I say? He knows the truth, sir, when he speaks.
I have to up my professional subscription. Am I missing things that are going on no wonder you have so many signups. I haven't thought about that as a marketing.
The sexiness just bleeds through the microphone, sir. What can I say?
It's just the great face for radio that he has, right?
Indeed.
I'm sorry, voice. I said that wrong.
Indeed.
So anyway, yeah, of course, as usual, Mike touches on all the things. One, I do believe we're in no man's land. A lot of my indicators are just getting up to their kind of tired positions. We've had about 11% run up from the lows in the SPY, around mid March. What I look at is implied volatility just kind of falling down since then. So it's just been on a straight line, and that usually will buoy the market. But it's getting to a point now where, these are where some of the turnarounds have happened. So I'm looking at that. So I'm getting a little worried. The contango is getting up to where it, not quite. Looks like it has a little bit left in this rally, but that is positively correlated. You want to see the front month underneath the back months, and that has been getting greater and greater as this rally has gone on. And then my favorite indicator that kind of predated the rally and continued going is this forward volatility indicator, where I compare it's called a flat volatility, where you calculate it off of the implied volatility of the time spread versus the calculated volatility of the forward. So it's a little bit more complex, but either way, that is when the market gets in duress, that goes south. So it's been going north and buoying the market as well. But again, it's up to kind of levels that when the market gets a little bit toppy, so all these things are going in the positive direction. So I'm not going to fight the trend, but starting to get a little bit high. So I guess I'm lukewarm bullish, but I think Mike's no man's land comment is a good one. We're in the DMZ zone here. Could go either way. Crude, I'm bearish on crude. I'm almost embarrassed to say I'm in this inverse short SCO, Sam Charlie Oscar. I'm not recommending it, but I'm just going, this is a $5 ugly ETF that just, and again, it's probably the stupidest thing to get into, but I just I had to get a flyer to.
Are you actually recommending this ultra short?
I'm not recommending it. I'm just mentioning it. Because I think crude's way too high. I think looking at the gas prices, I go, this is unsustainable in this economy. So I said, okay, I got to do something just to quell my thirst for this outlook that I have. So I'm on tape now, so you could see which way it goes. So that's how I'm feeling about the market, Mark.
Yeah, I'm looking at this SCO right now. This is the ProShares Ultra Short Bloomberg Crude Oil Index. If you are ETF, I should say, listeners, if you are not familiar, it's an intriguing one. It's down again today.
No, I got some right around 510, so that was the low, and it popped up to 6.5. I mean, This is a ugly thing. This is one of those double inverse things.
Do I even want to know how this thing is constructed? Probably not. I love these.
Close your eyes.
Exactly.
You look at the chart and you throw $100 at it, and you just then that will stop you from doing anything else that's stupid.
That's the old Brian says it on his OPR show. He says sometimes you have to just lie down until the urge goes away. But this is an intriguing. Is it optionable? I'll have to go dig in a little bit and see. But that's
totally. It's very liquid options actually. So I've got so you could really. You could buy a $10.
You're talking me into some upside calls in SCO, aren't you? You're doing it. I can hear you. I can hear you right now, whispering in my ear. You're the little devil in the cartoon that pops up on my ear and says, "Look at this." But yes, listeners, these are, like I said, interesting times. Crude poised at very precarious levels. You want to know more about crude, of course, tune in on our This Week in Futures options program. Every Thursday, we get into the skew and all the other data and metrics, the vol, unusual trades that are going on. I got a feeling crude oil will be making the list again this week. Always a fun program as we keep on rolling. No, it always makes the list as well as a little bit of the old earnings vol. So let's get into that right now.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
And I'm distracted by Matt's ultra short Bloomberg crude oil. Throwing me a curveball here. But you know what, listeners? This is the segment, the portion of the show. Again, another one we kind of had to codify with its own segment because we were talking about it so much here on the show. Of course, Matt, when he's not busy talking to us here on the show, he and his team are busy cranking away a whole bunch of cool numbers and trades and indicators, as he was just talking about, including a lot of earnings volatility. And Matt, we are kind of between cycles right now. So as you kind of mentioned, I get that no man's land analogy applies to a lot of what we're talking about here. We're kind of in earnings no man's land a little bit right now. There are still some names popping off, including this week. We had names like, Five Below and Lululemon's actually popping off today, I think, as we speak, and Micron and Dave & Buster's yesterday. So there are still some names popping off, but the hot and heavy big moments of the cycle, the 6 active weeks that I know you track actively over there at Orat's Mats, those are behind us. So we are waiting to re-rack for a new cycle. But, this is a rare opportunity for us to kind of dive in twice in the same month here on the show. I'm curious for you, have you been crunching the numbers and looking back on the past cycle? Any interesting highlights or takeaways stand out from you from the most recent season, sir?
Yeah, so thanks for the opportunity. We do have a chance to take a deep breath in between earnings cycles here, and many of the listeners have heard, but we break it down into 6 weeks, and the first weeks are generally the bigger companies, and then as far as straddle owners, it's difficult for those to profit historically on the first couple weeks, and then third, break even. Fourth and fifth, you start to do a little bit better, and then sixth and beyond is you get some stocks that don't behave as normal, the smaller stocks that are reporting late. So we like that, the sweet spot weeks, maybe 3, 4, and 5 if you're a long straddle. And then, of course, there's so many names it's hard to generalize, but that's how we basically look at it. We look at the straddle, but we have a way to pull out what we think is going to be left in the straddle after earnings. So we try to apply only what the market is thinking is going to be applied to that one day of the announcement. So we compare that to the actual move, and we've shown that to be pretty close to what actually happens. As you might imagine, it's a little bit better to sell than buy just because of that risk, but that's the way things line up. Mark, this particular season, we've concocted a new report that shows pictorially the history of what's expected in each stock. So once you get down, so what we've been doing is we've been saying, okay, is there any predictiveness? And we come down and we're saying, okay, usually we've done a lot of back tests, and the calendar is the best thing, but still in a calendar, you don't want it to move too much. So what we've added to that is looking at the last 12 earnings moves and what is implied, and to see how far outside. And we're finding that you want to try to get those stocks that are within that expectation, and that really helps your. It's pretty obvious, but that really helps your outcome. So we're continuing to add to this. We're approaching it from a macro level to look at which weeks of earnings season are the best, and then which stocks have back tested. And then also, once you get a stock, double check it against how much movement it has had versus expected movement. And then we feel like that's a pretty good time to get up at the plate for those. So that's where we are right now, Mark, with the old earnings time.
Ooh, a new report. I'm looking forward to it, sir. I love your graphical imagery you overlay on top of the report. So we'll look forward to checking that one out as well. In addition to the earnings move results, earnings season, and even the previous new trade, or I should say new report, which was the earnings trades reports, which of course you guys can find for yourselves anytime, not just during this show, over there at theoptionsinsider.com. Click on the options news and articles tab, and you're off to the races there. Meanwhile, we are off to our next segment, listeners. It is time to get the buzz.
Busy financial advisors and asset managers don't have time to follow the latest developments from the world of options, so we do it for you. It's time to get the buzz.
All right, everybody. Welcome to The Buzz, a portion of the show where we break down some of the interesting stories and developments going on in the world of options that you may have missed because you're busy out there actually doing your job, which is dealing with your clients. We get it. That's why we're here for you here on the old program. And first off, we have an article coming out of, well, really more of an image coming out of the Wall Street Journal. I believe they sourced some research out of the Bank of America quant strategy division and threw together an interesting infographic about financial advisors and what their approaches have been to different asset classes over the last few years. They start back in 2017, and they ask them, how are you currently changing your asset allocation? Which assets are you moving more assets into? And they gave them, multiple choices: equities, alts, fixed income, commodities, cash, or none of the above. And back in 2017, everyone was piling more money into equities. 42% of financial advisors out there were piling more money into equities, only 7% into fixed income, 15% were piling more money into cash, 11% only in alts, and 36%, so over a third, were doing none of the above. They were kind of just either doing something else or not piling in any additional assets at that time. 2018, interestingly enough, the equities fell off a cliff. It got cut exactly in half. 21% only were adding new allocations to equities. 13%, so nearly doubling for fixed income. It tells you a little bit of the tail of the tape between 2017 and 2018. 14% were adding more to cash. That stayed roughly the same. 18%. So that's a big jump for the alts from 11% to 18%, and 34% still again for none of the above. 2019, so leading into almost the pandemic year, they're right about on the cusp. And same levels for most things, 24% for equities, 20% this time for fixed income. So fixed income jumping up a little bit. Cash jumping up to 21% as well. Alts falling off a bit, 13%. And we get actually, interestingly, a 2% allocation to commodities. So that is separate than alts, which is usually those are all lumped together. And then 20% for none of the above. And then we get to 2020, the pandemic years, 26% piling things into equities, 15% going into fixed income, 12% for cash, 17% for alts. So alts starting to grow again, 2% again for commodities, 28% for none of the above. Now we get into more recent years, 2021, obviously fully in the grips of the pandemic. And everyone was loving equities again. 32% of advisors were diving and piling more money into equities. Only 5% for fixed income. You could probably understand why that was last year. 11% for the cash. Not a lot of action in cash. Folks were really getting fully invested. 22%. So that's kind of the narrative of this graph. They say financial advisors are really starting to aggressively add more to alts than they are even to stocks. So 22% for alts last year, 20% for commodities. So commodities go from being not even existing on this graph in 2017 to being fully 20% last year, and then 10% for none of the above. And then this year so far, we have equities coming off a bit, 24%, 8% for fixed income, 14% for cash, and then what really caught the eye of the Wall Street Journal folks, 28% for alts. So fully more financial advisors are allocating more resources to alts right now than they are to equities, which probably also tells you a little bit of where we are in the cycle right now. 10% for commodities. That has come down a little bit. Kind of hard to argue with that, though. We have seen some aggressive levels for both gold and crude out there, and 15% for none of the above. So a lot to unpack here. Mr. Uncle Mike, we'll start with you. Kind of an interesting trend. You know, we've lamented on this show in the past what I've kind of called myself the alts ghetto, how they just kind of lump everything alternative under this one mantle of alts. So it could be options, could be futures, could be art, could be real estate, whatever the hell it is. So the term alts is, I think, a little bit misleading, but still interesting from our perspective here on the show. I think that right now, even the journal's noting more advisors are allocating more resources into our neck of the woods, the alt side, than into straight equities. Does that surprise you, sir? Or is that kind of what you expected from what you've been hearing out there?
I would say it doesn't really surprise me that much, just because of the fact that with markets at an all-time high, advisors have ridden the wave of the bull market the last few years. And just a lot of people, and at least in my annual reviews, have even just been saying, what else is there? At some point, the market's going to go down. Or, I mean, I know I've been hearing that for probably 5 years, but from my clients. But, quite honestly, my whole career, I've been hearing that from my clients. But when we've had the all-time highs with which we've had, and the fact that we had such a fast run-up from March of 2020 to December of 2021, and yes, I know that's with a 30% drop from the earlier 2020 from COVID. When we have that fast of a run-up, even the retail crowd, even non-institutions probably look at this and are like, this went up pretty quickly. And so I think just because we had such a fast run-up, that is what drove a lot of people to the alts. And bonds are still evil in the world right now, in the world of financial advisors, in the world of the clients. I think we're going to have to go down more in the bond prices before people start to like them again, just because of the fear. You can argue of whether or not the Fed rate increases are priced into the bonds right now, or whether they're not, or how much they are, how much they're not. But my point is that in the retail world's eyes, bonds are evil right now, and they're just going to be an awful thing. That I can tell you from being on the front lines. But the fact that if you can tell a client, okay, there's this collar out there, or there's this whatever you want to put in front of them for alts, maybe we can take some of your profits from your stocks and put into this alternative. That really does not surprise me that much, because I'm willing to bet there's a lot of advisors out there that have had conversations like that with their clients.
I would love to know what they include in this alts bucket, especially because they pull out commodities separately. Those are usually lumped together. So they're taking one proactive step. It's not all the same. That alts now could be real estate. That could be, like I said, fine art. That could be a lot of weird things that aren't, writing a covered call on your client's equities, but still intriguing stuff nonetheless. Mr. Matt, what are your thoughts on this? The trend certainly seems to be our friend right now, in that more advisors are piling into what we know and love, sir.
Right. But, you have to take it with a grain of salt. I started looking at this and I said, something's wrong here. The first year they had equities at 42 and then went down to 21. I think that was almost impossible. So if you add up the first column, it comes out to 111% on a 100% graph. And then the rest of them are right. So they already screwed up the graph. 42 plus 7 plus 15 plus 11.
Leave it to the data guy to poke holes in the fun graphics. So
yeah,
there you go.
Like not even close. I'm just like, what is going on there? So, I'm not going to comment too much other than, yeah, great. But, come on, guys, get your calculator out and get the graph right at least.
Here I am trying to shine a ray of sunshine for all the advisors out there, telling them, hey, the rest of the world is jumping onto this trend. Get in the boat with the 10-year nose, Uncle Mike always likes to say. And yet, unfortunately, good old Mr. I can rely on Andrew for that kind of glass of cold water that right to the face. But in this case, you're his neighbor, Mr. Matt, and you're delivering here as well with it's just the New Englander in you. The cynic comes out. I understand. So yes, maybe graphical anomalies aside, hopefully the trend is accurate and meaningful. And for all of you out there, maybe first off, listening to a show like this, you can't be too far on the fence. But if you are on the fence, maybe this data from the Wall Street Journal by way of Bank of America will hopefully lure you to the dark side. Speaking of the dark side, let's see what's going on. Obviously, we don't have final numbers yet from our friends over there at OCC. We still have a few days left in the month, so we're going to do a little bit of speculating. Usually, this is the time of the show where we crunch the numbers and see how well are we doing? Because the number one question people have been asking and have had on their brains from a solely options perspective ever since this pandemic began is, hey, can this party continue? Can this options palooza, this tsunami of volume, can it continue month after month after month? And so far, for all of 2020 and all of 2021, the answer was yes, put up nearly 10 billion contracts last year, listeners. That's just an absurd amount of volume. So coming into this year, we kind of had a high bar to really meet. And the question was, can we do it? January certainly popping off. It was a very, very active month. I believe the busiest month in the history of the business in January, certainly the busiest January in the history of the business. February, as you mentioned on our last show, kind of fallen off a little bit. ADV down a little bit, not a ton, still a very active month by way of comparison to most other years. But in light of recent history, coming off a little bit. And now looking at the numbers right now for March, OCC will keep kind of a rolling tally of what the ADV is, which is, of course, the average daily volume out there of options right now. And right now we're coming into showtime today. We're at about 42.8 million. Now that sounds like a lot, and that is a lot. If you go back even a year or two, that's going to be much higher than what we were seeing. But also it's below the level that we just saw for February, which was 43.7 million. So you're talking down nearly 1 million contracts a day, about 900,000 contracts compared to February. And of course, February was no slouch month. We had the Ukraine invasion kicking off in February, as well as a lot of other developments leading into the Fed. A lot of things were going on that should have been drivers for options paper. So perhaps there are signs that there is maybe a little bit of a slowing of the trend. Obviously, with closing in on nearly 43 million contracts a day, that's still not nothing. But perhaps a sign that maybe the party is slowing a little bit. Mr. Mike, we'll start with you. I'm curious for your thoughts. I haven't had a chance to really talk to you much about volume so far this year, but as I said, we kind of kicked off the year very aggressive in January. It's kind of tailed off a little bit. I emphasize a little bit. These are not huge decreases here. And we're seeing a similar trend here for March. What are your thoughts on this year so far? You think we're going to still be on track for another record year, or maybe will it mitigate a little bit towards the end of the year?
I think the key player in that is Vladimir Putin, quite honestly, because he would be the one to where if he continues to do what he's doing and being the sinister evil villain with which he has shown to be lately, there's going to be a lot more need, I think, to hedge portfolios. If, let's say, tomorrow Vladimir Putin says, okay, we're done with Ukraine. We're not going to mess with them anymore. I don't think he will, but let's just say that he did. Then what I could see is I think we'd have a drop in the VIX. I think we'd have an increase in the S&P 500. But then what's ultimately would happen is that I don't know if the appetite for selling premium would be there quite as much with a lower VIX. And I think we'd be back to where we were. If we do go back to where we were a few years ago with the VIX kind of going between 9 and 12 all the time, then I don't know if we're going to have that much volume in a market like this. I think people would just, for the most part, just hold on to their stocks more. But I think if there's going to be more of a desire for options to be used as a hedge, then that would also create the desire for more people wanting to sell premium on the options. Then I think that it could go higher. So I think that we could have more volume, or continue to have really good volume, but I think it's very dependent on what's happening in the Ukraine.
Mr. Matt, same question for you. This is a subject we've been monitoring here on the show for quite a while. It seems like a little bit of a downtrend right now, but as Mr. Uncle Mike alluded to, that could turn on a dime if we start shelling reactors and all sorts of other crazy things out there in Ukraine. So what are your thoughts on the somewhat mitigating volume trend, and do you think that will change as we progress further in the year?
Well, you've heard my refrain that a lot of these options are highly correlated with the Fed's liquidity out there. And I think as they start to tighten, it's going to hurt options, notwithstanding the insanity in Ukraine land. By the way, I'm not one of the people that think it's only Putin's fault. I think it's a lot of NATO's and the crazy globalists are equally, if not more, to blame. So I think it's kind of a theater. So I actually don't think it's going to be that crazy, unless they have to. So I think we're going to be down in equity options. I've made that call at the end of our last year's show, and I'm sticking with it, Mark.
And we're sticking with you folks, listeners. You guys have been very, very patient with us, sending in a lot of questions, waiting for your answers. So we're going to devote some time to you folks and cleaning out the mailbag. It is time to open up the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody. Welcome to the office hours, the portion of the show where we tackle as many of your questions as humanly possible here on the program. You guys have been obliging, so let's get to it. Let's kick things off. I like this handle, ETH87, maybe a bit of a crypto fan. They want to know, I don't have the time to spend on maintaining my portfolio. Do you think that it is worth it for me to hire an advisor, or do you think that I could use a passive approach and still use options? An interesting question. We don't get a lot of people writing in saying they don't have a lot of time, but they still want to use options. That's interesting. But Mr. Uncle Mike, this is an interesting question. You obviously are an advisor, so I'm curious what your thoughts are here for ETH. He says he doesn't have a lot of time to spend maintaining. That would sound like that's tailor-made for using an advisor. But he also wants to know if he could just be passive himself and still go the options route, sir.
stcharleswealth.com, ETH. That's all I have to say on that one. No, it's possible if you want to be a little bit more passive on it. Perhaps you can set up trades using some leaps or doing something along those lines. So it's definitely possible. But I personally would have a hard time trading options if I couldn't look at the positions every day. The one thing that you could do, I would say, is if you wanted to maybe own some stocks and sell some 2 and 3 month out covered calls, perhaps, or even a longer time frame, you could do that. But if you're looking to leverage yourself in any way, I'd say no, it's not possible. But if you're not looking to leverage yourself, meaning you're going to sell some covered calls on some stocks, then that would be a way with which to do it. Just my opinion, though.
Yeah, we have explored ETH some passive or more passive type strategies in the past, like, of course, stock substitution. That certainly gets to what Uncle Mike was talking about with the leaps. You can get a little bit more active if you wanted to with covered calls against that and things like that. So there are some more quote-unquote passive strategies, but still an interesting approach. Mr. Matt, there would sound like ETH is tailor-made for using an advisor. What are your thoughts here if he wants to go it himself and be more passive while still using options, sir?
Yeah, I mean, I agree with Mike. There's a lot to be said about using an advisor, but there's also a lot to be said about using options. He's listening to this show, so he has to be somewhat knowledgeable. If you get, I like the long-term puts, and when the vol gets high, you do a long-term put spread, and you try to figure out. It depends on his investment objectives too, and what kind of portfolio it is. So it's hard to say it's based on this, but I would say, in general, if you have a market portfolio and you want to protect it, you could do that with long dated puts, as we've talked about many times on the show, and when the market goes a little bonkers, then you either have to, if it goes up, you either have to restrike, or if it goes down, you could take some profits. So it just depends on what his investment objectives are. But it sounds like you could do it either way. But he's just going to have to see what he's trying to accomplish, and then talk to an advisor and see if you could do it yourself, or if he would need someone else.
Yeah, ETH never hurts to talk to a professional, get the lay of the land. Uncle Mike certainly is out there. He could fill that role for you. There are others in perhaps your local neck of the woods you could talk to along these lines, because it sounds like your situation might be conducive to a little bit of help. But we shall see. Let us know what you end up doing. We're curious here, ETH. Let's go out to I like this handle, Mentha Systems. Mentha Systems says, hello all. Well, hello, Mentha Systems. He says, do you share the same outlook on risk as this, quote, legendary advisor? And he sends a link to a story on Think Advisor from Jeremy Grantham. It says, who says the war in Ukraine means our risk profile for everybody has gone up. He also asks, should we be advising all of our clients to increase their risk tolerance under the current circumstances? Also, how do we justify a VIX in the low 20s with so much uncertainty hanging over the market? Well, I hate to break it to you, Mentha, but since you sent that in, of course, VIX has now dropped into the teens. So maybe you're even more outraged by that. Let's give our listeners a quick overview of this article he's referring to, listener. That said, it's this advisor named Jeremy Grantham. He says the war in Ukraine means risk profiles for everybody has gone up, because you can't rule out the Russians being a bit crazy and irrational. He says Putin is a borderline psychotic, which, again, when you're shelling active reactors, maybe kind of hard to argue that one. He's also the co-founder of Grantham, Mayo, and Van Otterloo Asset Management. He thought they were heading into a super bubble in January, and but he thinks that flight path, as he says, is not as certain as it was a month ago. This war there's never been a war thrown in the middle of a major bubble like this. A month ago, he was sure the broad market was nearing its give up the ghost level. Now we have to put an asterisk on that. The war bodes badly for global trade, et cetera, et cetera. He also mentions interesting vampire phase of the market, not a term I'm familiar with. He says that even though institutions are selling, individuals are investing at a more rapid rate into the market decline than they were at the market rise, which is also unheard of. So individuals are buying as institutions were selling at a very aggressive rate. So Uncle Mike, we'll start with you. A lot to unpack here, sir. This kind of the broad strokes in this article is that he thinks advisors across the board need to raise their risk profile and indeed their risk tolerance for their clients right now, given what's going on out there. Do you agree with that? And then B, a corollary to Mentha's question, he wants to know how do you justify a VIX in the low 20s with so much uncertainty hanging over the market, sir? So a twofer for you.
Okay, so in terms of the risk profile, I think, my opinion, and this is a very deeply held belief of mine, your risk profile, your risk analysis should not be based upon current events. It should be based upon what the client's long-term objectives are. And so if you believe that you're willing to take on some risk for the longer term, then I think that's something that it shouldn't change, because ultimately throughout time, most things like what's going on in Ukraine are going to be blips on the radar over the long term. So I don't think it's something that should change. Now, within the risk profile, let's say that within your stock portfolio, you want to have this much risk on the table, or have stop losses here, there, or the other, or maybe you want to have these types of stocks or those types of stocks. I think that needs to be modified based upon what's happening right now. But in terms of the overall risk profile of how much money you should have and what assets, then I really don't think that that's something that should change based upon a current event. If you are looking at this from a long-term perspective. Once again, within the strategies, if you're looking to be more careful with it, then that would be where I would say the risk profile, or the risk management, I guess would be a better word for it, could, and I think in this case should change. In terms of the VIX being in the low 20s, well, of course it's not right now, but having the VIX at these levels with everything that's going on, as of right now, everything is fine, at least in the market view of it. But understand that if all of a sudden bombs go off in Poland and we have more problems along those lines, then that VIX could easily go back up to the mid-30s in one evening if something like that were to happen. So I think that for right now, the perception of the market is that things are calming down in the Ukraine. COVID is over again for the 8th time, although it probably will start again. Who knows? There's a lot of good news that's happening from that standpoint, but understand that we're still in an environment to where one headline and we're going to have a 35 VIX.
Yeah, how crazy is that? We've been talking for most of the show now. I haven't even mentioned COVID till now. So, I mean, that shows how many other things are popping off right now. But good question here. Let's go out to Matt. Same question for you, sir. What do you have to say about this quote unquote, as he puts it, legendary advisor saying the risk profile for everybody has gone up now because of Putin, sir?
The risk profile, everyone's risk has gone up, yeah, definitely. But, he's calling it a super bubble, and, I like to search for these guys, what were they doing in 2017? He was saying the same thing. As a matter of fact, not only saying the same thing, they used the same picture of him. So, 5 years ago, same picture, saying the same thing. As Mike was saying earlier, people have been calling for the market to crash, and you would have missed, 50, 75%. And what's it going to crash? 30%. So, I think you got to say somewhat invested. It does seem like there is a hidden hand holding this market up, let's say. And they're trying to make people scared. If you look at and then to get the second part of the question, the volatility. I mean, we've only been moving at a 15 volatility. Meanwhile, the vol of the S&P was up at 20s and such. So, I mean, yeah, this is, the IV is going to fall, but yeah, Mike's right again too. If we're only a few headlines away from a much higher VIX. So, that's how I take that with a grain of salt. And definitely research these guys that you're going to be listening to and see what they said historically.
Yeah, the vol part of that question is easy. Obviously, I've said it many times on vol views. At the end of the day, volatility is just movement. If you don't have the movement to justify the levels, the math is pretty basic at the end of the day. The other part could be a little bit more drawn out and debatable, but intriguing question there, Mr. or perhaps Mrs. Mentha. Speaking of vol, let's go on out to this one here from Eric Lehner. He says, hello, Advisors Options crew. Well, hello, Eric. He says, I was listening to the vol views last week. Oh, he's a full network fan. I was listening to vol views last week, and I heard Mark talk about someone trading nearly 20,000 of the June 130 calls in VIX for 18 cents. Yes, I vividly remember that print. It was interesting. Made for some good fodder on the show, Eric. He continues here. It made me wonder about Matt's tail risk put strategy in SPX. Could someone be doing something similar in VIX calls? I wonder if Matt has ever tested these. Do they work the same, better, or worse than the SPX or SPY garbage puts for capturing tail risk? So, Matt, this is kind of your infamous, you've called them your garbage puts in the past in SPY or SPX. Pick your poison out here. But Eric's talking about we profiled some pretty far out of the money June 130s going up last week in VIX as well. He wants to know are these analogous to your garbage puts in terms of performance, and have you ever back tested these as opposed to the puts?
Yeah, we have, and I should say that I don't want to talk my book too much, but I'm staring at the SEP 120 call for 22.5 cents.
I had a feeling you might be hanging out somewhere around there. When I saw that print, I said I should call Matt and see what he's up to. Did he buy 20,000 of these Junes?
Yeah, that's not me though. But I like having those. It doesn't have to get up there, but these things you buy them, you get enough time. They don't cost anything, and then lo and behold, when that headline comes through, these things go up tenfold sometimes. So. Again, it doesn't have to go up there. It just needs to scare the market, and those things just go bonkers. So I think those are, again, you want to have tails. You never know what's going to happen. In low volatility environment, things are normally distributed. When things get bonkers, anything could happen. I think you like to have those on. They're cheap. And why not? So yeah, I do think they're similar. It's hard to backtest them because, you only have 3 or 4 data points. So you kind of have to use use your head a little bit. But I mean, you can. I backtest them a little bit, right? So and you can see them pop. And what I like to do is just look at the actual, use our API. You could go back in history and see what the markets were and see what happened, a day or two after a big vol event. So I'm a fan. They're cheap. They don't go down in price that much. And you could get a pop in them easy. And then you got to be ready to get out, though.
Yeah, quick on the trigger finger, I think, is the key for these. Do you have a preference, the garbage puts or I guess the garbage calls, or do you kind of view them in the same bucket?
Well, the garbage puts aren't garbage anymore. They're so expensive. The vol has gone up so much. The skew came down a little bit. So today and yesterday. So which is to say, the puts have come down relative to the calls. There's some call buying out there. And so it's difficult to get some cheap puts now. So these might be a surrogate for those. Again, I like doing put spreads in these types of time. And I also like doing diagonals because there are some overvalued blips in the surface on these times, but that's a little bit more difficult to do. But yeah, these are good. These act a similar way. So I don't think they're that bad, Mark.
All right, interesting question there, Eric. Yeah, we joke about these on vol views, and obviously on the surface they do seem absurd, but as Matt points out, you don't have to get there. That's the key to these. If you think about trying to hold these at some sort of, expire in the money type trade, that's absurd. But if you can just get that pop that Matt's talking about, that's a very different scenario entirely. All right, let's get on out to, let's see, we got time for about probably one more here. Let's go to Andrew. Love when we're trying to clean out the listener mail here. Let's go to Andrew Z. He says, I very much enjoyed the recent episode on covered calls. Yeah, that was a few episodes ago, Andrew. Thank you. He says, my question is, how much can you extend this strategy to the crypto markets? I know that staking is very popular on many leading crypto exchanges. Would it be possible for me to actually write covered calls on my clients' crypto assets that have already been staked, effectively creating a second income stream? I think that would be a tremendous benefit to my clients and to crypto options traders overall. Thank you very much for all that you do. A couple of our guests on the Crypto Rundown have expressed a similar sentiment, Andrew. They would love to be able to write covered calls on things that they have already staked. The rules and the requirements on different venues do kind of get in the way of that quite often for understandable reasons. Also, we just had our guest on the Pro Q&A just an hour and change ago, Eric, mentioning that he thinks this kind of staking ecosystem, how it's kind of spiraling a little bit out of control, could end up posing some systemic risk to the overall crypto markets as a result of perhaps things like you're talking about, things getting a little bit overzealous, shall we say, from an income perspective. I don't know, Mr. Matt, it's an interesting idea. It'd be nice to be able to do covered calls against things you have staked. What are your thoughts here for Andrew? And this the notion of taking what we've talked about in the past, which is our crypto, or I should say our covered call strategies and applying them to crypto, sir?
Well, I'm a BITO fan. I'd made my first trade here on the when you told me that they had just started trading, and so I've been doing that. Unfortunately, though, the implied volatility has come way down. It was up in the 80s, almost 90, and now we're down at 60 and 50. So it's not quite as lucrative anymore. But you could sell a call spread, you could get in BITO, and you can get some, get a little bit of income that way. Again, right now, there's not much. It's not as fun anymore. I mean, the slope is still decent around zero, meaning the puts and calls are trading relative parity in terms of IV. So you could do that collar that I was talking about, or a call spread collar, as some might call it. So that you don't want to try to stake things twice. You don't want to be naked crypto. So you want to always have units, meaning you want to be long something and short something. I have BITO off. I have Bitcoin somewhere else, so I know I could handle it if I do sell a call. But I would not recommend that. I would recommend doing a call spread, Mark.
Yes, indeed. Since we're talking covered calls, I lied. We're going to squeeze one more in, listeners, because we like you folks so much. This comes from Curtis. He says, I believe Matt has noted in the past that when choosing covered call strikes, further out of the money strikes tend to equate to higher profits. But isn't that normally for bull market periods? Doesn't selling closer to at the money increase income and performance in choppy markets like we're experiencing right now? Thank you very much for reading and answering. Well, I'm going to get both of your thoughts on this because covered calls are very near and dear to this program. We'll start with Matt because he is directly invoked in the question. Then I'm going to get Uncle Mike's thoughts as well. Mr. Matt, sir, what are your thoughts on Curtis, who says in the past you have mentioned farther out of the money covered calls, and that usually tends to be the barometer for profit because it was stock appreciation that made up the lion's share of the profit. Have you maybe amended that in the current markets? What are your thoughts about him thinking maybe selling closer to at the money might be better for these types of markets?
Again, he's making a pretty strong call in the market. I don't think you could just brush that off. I mean, I think that you look at history, and over that history, it still holds. So, I mean, the key to it is to find stocks or find ETFs that have a high volatility where you get a certain percentage of it and sell it as far out as far as strikes goes, and then as close in as possible. So you want to have a good scanner. We have good scanners that we find these things. So those are the keys to it. You just don't sell something too close in that you're not getting paid an awful lot of money for. So that's that. And I have a whole on our blog. I have a whole. We ran 3 million simulations and have a bunch of the rules that came out. We've mentioned it a few times here. So that's how I think about it, Mark.
All right, Mr. Mike, same question for you, sir. I know covered calls are kind of your bread and butter. What are your thoughts for, in general, the notion of writing pretty far out of the money in order to capture that appreciation on the stock? And maybe, as Curtis puts it, maybe amending that now to getting a little bit closer to at the money because of the chop that we're seeing out there right now, sir.
On stocks, I typically like doing them further out of the money. And I've talked about on the option block a bunch of times, we've really gone to a lot more of a call spread model, meaning that we'll sell call spreads against stocks. So that way, if in our portfolio of stocks, there's always one stock that just goes through the roof in a bull market, and even if the rest of them don't go that much or don't go that high, because we're typically looking for more stable stocks that have decent premium on them. But by doing more call spreads, you enable that one stock to just go through the roof and ultimately give you the best returns. So I typically do lean more towards out of the money covered calls when we're not selling call spreads.
All right, listeners, I did my darndest to squeeze as many of you in as possible. Thank you for your patience. So many of you have written in. Glad to see so many of you are enjoying the program. Unfortunately, that music means we've come to the end of our second episode of the Advisor's Option. Gave you a bit of a double dose this month. Hope you're all liking it. But before we go, let's go around the horn. Let's start with Uncle Mike. You are our guest today, sir. Mr. Uncle Mike, if folks are Blanking on that guy's name. What was it? If they're like ETH87, maybe they're thinking about maybe they could use an advisor. Where should they go? What should they do?
A couple of places, or a few places, actually. First place, check out my YouTube channel. Just type in St. Charles Wealth Management. I'm trying to put out roughly one strategy per week for 2022, hopefully 50 by year's end, roughly. You can also follow me on Twitter at Mike TOSAW, TOSAW, or check out my website, stcharleswealth.com.
He's becoming an online and a social media maven. Of course, you can find him on the Option Block twice a week. He has his YouTube now cranking away on the old YouTubes. He's on Twitter. You can't escape Uncle Mike over there at Mike TOSAW on the old Twitters as well. And Mr. Matt, you are also inescapable in your reports, your back tests, your tweets, as well as some, I think, a cool new dashboard you guys are working on. What's up your sleeve these days over there at ORATS, sir?
Yeah, I mean, we're really excited about the dashboard. We've gotten some comments back from testers that love it. I've never seen such high praise, so we're really excited about it. I teased out that earnings page. That's just one of them. We also have a little bit more fundamentals, but we have a thing called the trade builder where you could really visualize what you're doing and slide strikes around to get the payout picture exactly how you like it. You'd love this as a past market maker. We have a very visual options chain. You can tell on the chain graphically where you're trading. We have the stock scanners and option scanners that help you find the right covered calls, for example, the right iron condors, and of course we have the back tester to go with it. So we've been rocking, and we got a great team of developers, and we're just continuing to push great stuff out there. So come on over to orats.com. Email me, Matt at ORATS, if you want to demo something and provide some feedback. Let me know.
There you go. ORATS.com, ORATS.com is the place to go to kick the tires and light the fires. If you like all these things we've been talking about here throughout the show, the covered calls, back tests, all the other things we're talking about here on the show, ORATS.com is the place to go. And of course, you know where to go for all you advisors out there looking for a little bit more education and information. Optionseducation.org. Our friends over there at the OIC have a great back catalog of educational content for you folks. Some of that specifically for you advisors. Click on that advisors tab and you are off to the races there. And we are off for the rest of the show, listeners. We'll be back again tomorrow. Don't you worry. For your double dose of education. If you want more education in your lives, listeners, Options Bootcamp, Options Playbook Radio, two great places for you to start. We'll take you from A to Z in the world of options education. Thursday, of course, back for This Week in Futures Options, as well as episode 2 of the Option Block. Friday, Volatility Views, and, of course, Options Oddities for all of our pro members out there. Then we're back again next month. It's already coming up on April. Hard to believe. Next month with another episode of the Advisor's Option. Stay safe out there, everybody.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.